For months now, investors have been hearing a compelling story. Robots are installing solar panels faster than ever before. Gigawatts of renewable energy capacity are being deployed across deserts, rooftops, and industrial zones. And because solar panels require silver, the conclusion seems obvious. Demand for silver is about to explode. It sounds persuasive. But persuasive narratives are not always the same as investable reality. And in markets, timing matters more than storytelling. The claim that robotic solar installation is about to trigger a structural silver shortage assumes something very important: that deployment speed automatically translates into immediate metal scarcity. Yet history shows that commodity markets rarely respond that way. Supply chains adapt. Technology evolves. Substitution occurs. And most importantly, demand projections frequently overshoot reality during early cycle hype phases. Yes, automation is accelerating solar deployment, but automation does not eliminate constraints, it merely shifts them. The key mistake many analysts are making right now is assuming that labor bottlenecks were the primary limiting factor for solar expansion. In reality, capital availability, grid integration timelines, permitting delays, and storage infrastructure remain the dominant constraints. Removing workers from installation crews does not remove financing cycles. It does not remove regulatory approvals, it does not remove transmission bottlenecks, and those factors, not labor, determine how fast gigawatt-scale solar capacity can actually come online. So the idea that robots suddenly unlock unlimited solar expansion, and therefore unlimited silver demand, is far less certain than it appears at first glance. Even the frequently repeated statistic that each gigawatt of solar capacity requires roughly 700,000 ounces of silver deserves closer inspection. That number reflects historical averages, not future technological trajectories. Solar manufacturers have already spent more than a decade reducing silver intensity per panel. They are still reducing it. In fact, one of the least discussed trends in the photovoltaic industry today is aggressive silver thriftiness. Engineers are continuously lowering silver usage through thinner conductive lines, alternative metallization techniques, and hybrid copper-based substitutes. These innovations do not eliminate silver demand entirely, but they absolutely slow its growth rate. And slowing the growth rate is enough to change the entire supply-demand equation, because commodity shortages are not determined by absolute demand levels. They are determined by the rate of change. This distinction matters. When analysts project hundreds of gigawatts of annual solar installation translating directly into hundreds of millions of ounces of additional silver demand, they are implicitly assuming static material intensity. But material intensity in photovoltaics has never been static. It falls almost every year, which means future solar expansion does not necessarily translate into proportional increases in silver consumption. This alone weakens one of the strongest pillars supporting the bullish thesis. But there is a second assumption embedded inside the robotic solar revolution narrative that deserves scrutiny. It assumes that energy security concerns automatically accelerate renewable deployment timelines. That assumption sounds logical, yet historically, geopolitical instability has often delayed energy transitions rather than accelerated them. When oil supply disruptions occur, governments do not immediately pivot toward long-term infrastructure transformation. They stabilize existing systems first. They release strategic reserves. They subsidize fuel. They negotiate supply corridors. They secure shipping lanes. Only after stabilization do structural transitions accelerate, and stabilization takes time. In other words, short-term geopolitical shocks tend to support fossil fuel investment before they support renewable investment, not the other way around. This is exactly what happened after previous oil disruptions across the Middle East. Instead of immediate renewable acceleration, what followed was increased drilling activity, expanded LNG infrastructure, and intensified hydrocarbon diplomacy. Markets respond to urgency with practicality, not ideology, which means the assumption that rising geopolitical tensions automatically translate into immediate solar-driven silver demand may be overstating the timeline significantly. There is another structural issue that deserves attention. Solar expansion alone does not define silver demand. Industrial metals respond primarily to global manufacturing conditions, and right now, the global industrial cycle is not clearly accelerating. It is fragmenting. Europe remains weak. China is stabilizing but not booming. The United States is resilient but slowing. In that kind of environment, demand projections based purely on renewable energy expansion risk, ignoring broader macroeconomic reality. Because when recessions emerge, or even when growth simply slows, industrial demand for metals weakens across multiple sectors simultaneously. Electronics production slows. Electric vehicle adoption pauses. Construction activity declines. Telecommunications infrastructure expansion delays. And those sectors collectively consume far more silver than any single renewable deployment cycle. So while solar is certainly an important driver of future silver demand, it is not the dominant one. And it is definitely not immune to macroeconomic slowdown. This is why projecting a straight-line increase in silver consumption based solely on renewable expansion creates a misleading picture of market dynamics. Commodity demand does not move in straight lines. It moves in cycles, and we are currently late in one of the longest global tightening cycles in decades. That matters, because late cycle environments historically produce volatility, not structural shortages. Another key point that is frequently overlooked in the bullish narrative is inventory behavior. Supply deficits in commodities sound alarming. 6 consecutive years of deficit sounds even more alarming. But deficits alone do not determine price direction. Inventory levels determine price direction. If inventories remain sufficient to absorb multi-year deficits, price pressure remains limited. And silver inventories, particularly those held across exchanges, private vaults, industrial stockpiles, and sovereign reserves, are far less transparent than many investors assume. Visible inventory decline does not necessarily equal physical scarcity. It often equals relocation, metal moves, between exchanges, between countries, between institutional holders, between industrial users. And unless inventories reach critical depletion thresholds across multiple regions simultaneously, the market rarely responds with sustained vertical price moves. This is why repeated references to 6 consecutive years of supply deficit should be interpreted carefully. Structural deficits are meaningful, but only when they intersect with visible inventory exhaustion, and that intersection has not clearly occurred yet. Which brings us to the final assumption embedded inside the robotic solar acceleration thesis, the assumption that supply cannot respond. This claim sounds intuitive. Mining takes years, exploration takes decades, permitting is slow, all true. But commodity markets do not wait for new discoveries to respond to higher prices. They respond through production optimization first. Existing mines expand throughput. Processing improves recovery rates. Marginal deposits become economic. Secondary supply increases. Recycling accelerates, and substitution begins. These responses happen far faster than greenfield mine development, which means supply elasticity exists, even if it is not immediately visible. And once prices rise high enough, that elasticity expands rapidly. This is exactly how commodity markets rebalance, not through sudden geological miracles, but through incremental operational responses across hundreds of producers simultaneously. So before concluding that automation-driven solar deployment is about to create an unavoidable silver shortage, investors should consider whether the narrative reflects structural inevitability or simply early cycle enthusiasm amplified by technological headlines. Because in commodities, the difference between those two interpretations determines everything. And right now, the evidence suggests the market is still deciding which one this is. One of the strongest arguments supporting the bullish silver thesis today is the idea that the market has entered its 6th consecutive year of structural supply deficit. At first glance, that sounds decisive. 6 years of deficits should imply tightening supply. Tightening supply should imply higher prices, and higher prices should imply an inevitable repricing cycle across the entire silver market. But commodity markets rarely function in such a linear way, because deficits alone do not determine price direction. Liquidity determines price direction. And liquidity in precious metals markets is driven less by industrial consumption and more by financial positioning. This distinction matters far more than most investors realize. Silver is not purely an industrial metal. It is a hybrid asset. It trades partly like copper, partly like gold, and partly like a leveraged macro sentiment instrument, which means its price behavior is influenced as much by ETF flows, interest rate expectations, and currency conditions as it is by fabrication demand. So when analysts point to a 6-year structural deficit as evidence of unavoidable upside pressure, they are implicitly assuming that physical supply constraints dominate pricing behavior. History suggests otherwise. In fact, some of the largest silver price declines of the past 2 decades occurred during periods when fabrication demand remained strong. What changed during those declines was not industrial usage, it was investor positioning. And positioning remains the single most powerful short-term force in the silver market today. Consider the recent liquidation dynamics inside silver exchange-traded funds. When large ETFs reduce holdings, they effectively release supply back into the market faster than industrial demand can absorb it. This creates downward price pressure even during periods of structural consumption growth. In other words, investment flows can overwhelm physical shortages, and they frequently do. This is one reason why multi-year deficit narratives often fail to produce immediate price responses. Markets respond to marginal supply, not cumulative imbalance. That is a crucial difference. If the marginal seller is a large institutional holder reducing exposure, prices fall regardless of long-term structural fundamentals. And that is exactly what we have already seen during recent months of volatility. Which raises an important question. If 6 consecutive years of deficit have not yet produced sustained upward momentum, what makes the 7th year different? The answer is not as obvious as many analysts suggest. Because deficits only become decisive when they coincide with inventory exhaustion and capital inflows at the same time. And we are not clearly there yet. There is another assumption embedded inside the deficit argument that deserves closer examination. It assumes that silver consumption permanently removes metal from circulation. That claim is partially true, but incomplete. Yes, silver used in solar panels, electronics, and medical equipment is not immediately recycled back into the market. But not immediately is not the same as never. Commodity markets operate across decades, not quarters, and over longer horizons, recycling becomes one of the most important sources of supply adjustment. When prices rise, recycling accelerates. Industrial scrap returns to the market. Consumer products are recovered. Electronic waste processing expands, and secondary supply begins offsetting primary shortages. This mechanism has repeated itself across multiple metals over multiple cycles. Silver is no exception. In fact, silver recycling historically increases sharply during periods of price appreciation, acting as a natural stabilizer against runaway shortages. So the idea that every ounce used today permanently disappears from market circulation exaggerates the long-term scarcity argument. It reflects a short-term perspective applied to a long-term commodity cycle, and commodity markets punish that kind of mismatch. There is also a deeper structural issue with the deficit narrative that is rarely discussed. Supply deficits do not always reflect true scarcity. Sometimes they reflect accounting definitions. Global supply calculations typically include mined output plus recycling. Demand calculations include industrial fabrication plus investment flows. But investment demand is volatile. It expands rapidly during risk-off cycles. It contracts rapidly during liquidity tightening cycles. Which means deficits driven by investment flows are fundamentally different from deficits driven by industrial consumption. One represents structural imbalance. The other represents cyclical positioning. Failing to distinguish between those two categories can lead investors to misinterpret the signal entirely. And right now, a meaningful portion of the reported silver deficit reflects financial demand behavior rather than irreversible industrial consumption. That difference matters enormously when forecasting price trajectories. Because financial demand can reverse quickly, industrial demand cannot. Another pillar supporting the bullish thesis is the claim that geopolitical instability, particularly tensions involving major oil shipping routes, will accelerate the global transition toward renewable energy and therefore increase silver consumption dramatically. This argument sounds intuitive, but history again suggests caution. Energy transitions are not triggered by short-term shocks. They are driven by long-term cost curves. Oil disruptions create urgency. But urgency does not automatically translate into infrastructure transformation. In many cases, governments respond to energy insecurity by increasing fossil fuel investment rather than replacing it. They expand domestic drilling. They strengthen strategic reserves. They secure maritime protection routes. They negotiate alternative supplier relationships. These responses happen faster and more predictably than large-scale renewable deployment, because they rely on existing infrastructure rather than new systems, which means the assumption that geopolitical tension automatically accelerates solar deployment and therefore silver demand may be overstating the speed of transition. Energy systems evolve slowly. Even when politics changes quickly, There is another overlooked risk embedded inside the silver equals energy security argument. It assumes that solar deployment scales independently of capital markets, but solar expansion is capital intensive. Utility-scale installations require financing. Grid upgrades require financing. Battery storage integration requires financing. Transmission expansion requires financing. And financing conditions depend heavily on interest rates. When interest rates rise, renewable deployment slows, not because demand disappears, but because projects become more expensive to fund. This dynamic has already been visible across multiple regions during recent tightening cycles. Higher borrowing costs delay installation timelines. Developers postpone projects. Governments revise subsidy structures. And deployment curves flatten. So even if geopolitical pressure increases the strategic importance of solar energy, the pace of expansion still depends on monetary conditions. And monetary conditions remain restrictive compared to the previous decade, which introduces uncertainty into the assumption that solar-driven silver demand will accelerate without interruption. Finally, there is perhaps the most powerful narrative claim of all, the idea that silver is becoming the new oil. It is an appealing comparison. Oil defined the geopolitics of the 20th century. Silver appears positioned to support the electrification systems of the 21st. But analogies between resource cycles often oversimplify reality. Oil was dominant because it concentrated energy. Silver enables conductivity. Those are fundamentally different roles inside the global economy. Energy resources create dependency, industrial materials create optionality, and optionality always invites substitution. When oil supply tightens, alternatives are difficult to deploy quickly. When conductive metals tighten, engineers redesign systems. They reduce usage intensity. They substitute materials. They improve efficiency. They innovate. This flexibility limits the extent to which any single industrial metal can replicate oil's strategic dominance. So while silver is unquestionably important for electrification infrastructure, describing it as the new oil risks overstating its structural leverage over the global energy system. And when narratives overstate leverage, markets often price in expectations faster than fundamentals can justify, which is exactly when volatility increases. Because the difference between strategic importance and irreplaceability determines how high prices can sustainably rise. And silver, despite its importance, is still operating inside a system that constantly adapts around constraints, not inside one that collapses because of them. At this stage of the silver narrative, the bullish argument usually shifts from structural fundamentals toward technical confirmation. Charts begin to matter more. Trend lines begin to matter more. Ratios begin to matter more. And institutional forecasts suddenly appear to reinforce the idea that the market is approaching a decisive upside breakout. But technical compression patterns do not guarantee directional resolution. They only guarantee volatility expansion. That distinction is critical. A symmetrical triangle, especially one forming near the end of a quarterly cycle, represents uncertainty, not confirmation. It reflects balance between buyers and sellers. It reflects hesitation. It reflects positioning tension inside the market, and when markets compress like this late in a macro-tightening environment, resolution often depends less on commodity fundamentals and more on liquidity conditions. Because liquidity, not scarcity, is usually the dominant force determining breakout direction during transitional phases. This is particularly true for silver. Silver behaves differently from most industrial metals. It is more sensitive to real interest rates, more sensitive to dollar strength, more sensitive to ETF positioning, and more sensitive to macro volatility, which means technical breakout structures inside silver should never be interpreted in isolation. They must be evaluated within the broader monetary environment. And that environment remains restrictive, even when headline inflation moderates. Even when commodity demand stabilizes, even when growth expectations improve, restrictive monetary conditions change the probability distribution of breakout outcomes. They do not eliminate upside potential, but they do reduce the likelihood of sustained vertical moves without confirmation from capital flows. This brings us to another widely cited bullish indicator, the gold-to-silver ratio. Historically, when the ratio rises above certain thresholds, analysts often expect silver to outperform gold during subsequent recovery phases, and statistically, that observation has merit. But statistical tendencies are not timing signals. They are conditional relationships. The ratio can remain elevated for extended periods when macro uncertainty dominates industrial demand expectations. It did so during multiple cycles across the past 3 decades, which means interpreting a high gold-to-silver ratio as an imminent trigger for silver outperformance risks, confusing historical tendency with structural inevitability. Ratios normalize eventually, but eventually is not the same as immediately, and markets punish investors who mistake one for the other. There is another issue with the ratio argument that deserves attention. Gold and silver respond differently to stress environments. Gold benefits from monetary uncertainty. Silver depends on industrial confidence. When those two forces move in opposite directions, the ratio widens, not narrows. And right now, the global macro environment contains elements of both uncertainty and slowdown simultaneously, which explains why the ratio has remained elevated longer than many analysts expected. It is not a distortion. It is a signal. A signal that the market is still uncertain about the strength of the industrial recovery cycle. Another frequently cited pillar supporting the bullish silver thesis is the alignment of major institutional price forecasts. When multiple large banks project higher future prices, the narrative becomes more convincing. It appears coordinated, it appears validated, it appears inevitable. But institutional forecasts rarely function as predictive tools for short-term commodity positioning. They function as scenario frameworks. Banks produce forecasts based on assumptions about inflation, assumptions about monetary easing, assumptions about energy markets, assumptions about global growth. And when those assumptions change, forecasts change quickly. This is not criticism. It is simply how forecasting works. In fact, institutional commodity forecasts have historically displayed wide error margins during periods of macro transition, which means consensus projections should be interpreted as directional sentiment, not as confirmation of price trajectories. There is another structural reason why bank forecasts often appear optimistic near cycle transitions. Large institutions allocate capital across time horizons longer than retail investors typically consider. They are not positioning for the next quarter. They are positioning for the next cycle. And positioning for the next cycle does not guarantee smooth price appreciation along the way. In many cases, it implies volatility first, then repricing later. Understanding that difference changes how forecasts should be interpreted, because a long-term target is not the same as a near-term catalyst. This distinction becomes even more important when analyzing the mining sector. One of the most compelling arguments supporting higher silver prices today is the apparent valuation disconnect between mining companies and their projected cash flow potential. At first glance, the logic seems straightforward. If silver prices rise, mining margins expand. If margins expand, earnings increase. If earnings increase, equity valuations should follow. But mining equities rarely move in direct proportion to commodity price changes. They move in response to capital allocation cycles, operational risk assessments, jurisdictional exposure, cost inflation expectations, and investor appetite for resource sector leverage, which means valuation gaps between projected asset value and current market capitalization are not unusual. In fact, they are common, particularly during late-cycle environments, because equity markets discount uncertainty before they price in upside potential. This is especially true when expansion projects require capital investment before generating production increases. Even if those projects appear economically attractive on paper, markets apply risk discounts. They apply execution discounts. They apply geopolitical discounts. They apply financing discounts. And those discounts persist longer than many investors expect. Another overlooked factor inside mining valuation analysis is commodity price sensitivity asymmetry. Mining companies benefit from rising metal prices, but they are also exposed to rising operating costs at the same time. Energy prices increase, labor costs increase, equipment costs increase, environmental compliance costs increase. And those increases reduce the margin expansion effect investors expect from higher commodity prices. So even when silver prices rise, mining equities do not always reprice immediately. Sometimes they wait for confirmation, sometimes they wait for earnings releases, sometimes they wait for capital inflows, and sometimes they simply wait for macro uncertainty to decline, which explains why valuation gaps can persist longer than fundamental models suggest they should. There is another signal frequently cited as evidence of physical tightness in the silver market: backwardation. When spot prices trade above futures prices, analysts often interpret it as proof of immediate supply shortage. And in some commodity markets, that interpretation is correct. But in precious metals markets, backwardation does not always reflect structural scarcity. Sometimes it reflects temporary liquidity stress. Sometimes it reflects hedging demand. Sometimes it reflects delivery timing distortions. And sometimes it reflects positioning shifts inside futures markets rather than physical shortages in the real economy. Understanding the difference requires examining duration. Short-term backwardation can occur without long-term scarcity. Persistent backwardation across multiple contract curves is more meaningful, which means interpreting isolated backwardation signals as confirmation of structural shortage risks overstating their significance. Finally, there is the broader assumption that mining sector catalysts, earnings upgrades, exchange listings, production expansion announcements will automatically trigger institutional capital rotation into silver equities. This assumption sounds reasonable, but capital rotation rarely occurs in isolation. It occurs when macro conditions support risk-taking behavior across the entire commodity sector. Not just one metal. Institutional investors allocate capital across portfolios, not narratives. And unless broader commodity momentum strengthens simultaneously, isolated bullish signals inside one segment rarely produce sustained repricing cycles. So while the technical structure, the gold-to-silver ratio, institutional forecasts, mining sector valuations, and backwardation signals all appear supportive of the bullish case individually, none of them alone provide confirmation of imminent breakout conditions. They provide context, they provide probability shifts, they provide directional bias, but confirmation requires alignment across liquidity, macro policy expectations, industrial demand visibility, and capital allocation behavior. And that alignment has not fully appeared yet, which means the market may still be closer to decision than resolution. By this point, the bullish case for silver appears powerful. A 6-year structural deficit, accelerating solar deployment, electrification trends across transportation and infrastructure, supportive institutional forecasts, a historically elevated gold-to-silver ratio, and technical compression suggesting an imminent breakout. Taken together, these elements form a compelling narrative, but compelling narratives are not the same as completed cycles. And one of the most important questions investors must ask right now is not whether silver's long-term fundamentals are improving. It is whether the timing of the expected repricing cycle matches current macroeconomic conditions. Because commodity markets rarely move in response to fundamentals alone. They move when fundamentals and liquidity align. And that alignment has not clearly occurred yet. The single most underestimated variable inside the silver thesis today is the interest rate environment. Silver does not generate yield, which means its attractiveness depends heavily on the opportunity cost of holding it. When real interest rates rise, non-yielding assets become less competitive. Capital shifts toward bonds, toward cash, toward short-duration instruments, and away from metals that rely on future appreciation rather than current income. This dynamic has shaped nearly every precious metal cycle over the past 40 years, and it remains active today. Even if markets expect eventual monetary easing, expectations are not the same as policy shifts. Until easing actually begins, restrictive financial conditions continue influencing allocation behavior. This matters because commodity breakouts rarely occur during the tightening phase of monetary cycles. They occur during the transition into easing phases. Which means timing, not direction, is the central uncertainty facing silver investors right now. There is another structural factor that deserves careful consideration: global growth risk. Silver is not only a monetary metal, it is also an industrial metal, which means it depends on manufacturing strength as much as investment sentiment. If global growth slows meaningfully, industrial demand weakens across multiple sectors simultaneously. Electronics production contracts, electric vehicle rollout schedules shift, infrastructure deployment slows, telecommunications expansion pauses, and renewable investment timelines stretch, not because the transition stops, but because financing cycles change. This is one of the central paradoxes of silver. Its strongest long-term drivers are structural, but its short-term price behavior is cyclical. And when investors confuse those two time frames, volatility increases. Another overlooked risk inside the current silver narrative is substitution pressure. Silver is highly conductive, highly reflective, highly reliable, but it is also expensive compared to alternative conductive materials, which means rising prices do not simply increase mining profitability, they increase engineering incentives. When silver becomes too expensive, manufacturers redesign systems. They reduce usage intensity. They replace conductive pathways. They explore hybrid metallization techniques. They optimize component architecture, and those adjustments happen faster than many commodity investors expect. This process does not eliminate demand, but it limits acceleration, which changes the slope of the demand curve. And slope, not level, is what determines whether shortages become explosive or manageable. There is another timing issue embedded inside the energy transition urgency argument that deserves attention. Renewable deployment is not constrained only by panel installation speed. It is constrained by grid infrastructure, transmission capacity, energy storage integration, permitting cycles, land use approvals, and regulatory alignment. These constraints take years, not months, to resolve, which means even if robotic installation technologies accelerate panel deployment capacity, total system-level expansion still depends on infrastructure readiness. Energy systems evolve as networks, not as individual technologies, and networks move slowly. This introduces a lag between technological capability and actual commodity demand realization, which means automation alone cannot compress the timeline as dramatically as some forecasts suggest. Another major assumption inside the bullish silver narrative is that supply cannot respond quickly enough to rising demand. But commodity markets rarely behave that way. Supply does not respond only through new discoveries. It responds through operational efficiency, through throughput optimization, through recovery improvements, through recycling expansion, through project restarts, through marginal deposit activation. And these responses begin long before new mines reach production, which means supply elasticity exists earlier in the cycle than headline deficit numbers suggest. Understanding this elasticity changes how structural shortages should be interpreted, because structural deficits do not automatically produce immediate scarcity pricing. They produce gradual repricing pressure over time unless liquidity conditions accelerate the process, and liquidity conditions remain uncertain. There is also a behavioral factor influencing silver markets today that deserves attention: narrative concentration. When multiple bullish arguments converge simultaneously, automation, electrification, geopolitics, deficits, technical compression, institutional forecasts, they create the impression of inevitability. But markets rarely reward inevitability narratives immediately. They test them first. They challenge assumptions. They force positioning adjustments. They create volatility before confirmation. This pattern has repeated across nearly every commodity cycle in modern history. Oil in the early 2000s, copper in the mid-2000s, lithium in the late 2010s, uranium in the early 2020s, and in each case, the strongest narratives appeared before the strongest price moves, not during them. Which suggests the silver story today may not be wrong. It may simply be early. There is an important difference between those two possibilities. If the thesis were wrong, the structural drivers would disappear. But they have not disappeared. Solar deployment continues. Electrification continues. Digital infrastructure expansion continues. Medical technology demand continues. Artificial intelligence infrastructure continues. These trends remain intact. What remains uncertain is the timing of when capital markets fully price them. Because commodity markets respond to alignment. Alignment between macro liquidity, industrial acceleration, investment positioning, policy direction, and infrastructure readiness. When those forces converge, repricing cycles become powerful. Until they converge, markets remain transitional. So the real question facing investors today is not whether silver has a structural future. It clearly does. The question is whether the market is already positioned for that future. or still waiting for confirmation that the cycle supporting it has actually begun. And until that confirmation appears, volatility remains not a contradiction of the bullish thesis, but a normal part of its development. So where does all of this leave investors today? Because after examining the solar automation narrative, the 6-year deficit thesis, institutional forecasts, mining sector valuation gaps, technical compression signals, and geopolitical energy transition arguments, the most important takeaway is not whether silver is bullish. It is whether silver is positioned for an immediate breakout or still building the foundation for a longer-term repricing cycle. And those are two very different investment environments. Right now, the market is showing signals of transition, not confirmation. Structural demand drivers are real. Electrification is real. Solar deployment expansion is real. Digital infrastructure growth is real. Medical technology demand is real. Artificial intelligence power consumption is real. None of these trends are speculative. They are measurable. They are accelerating, and they are unlikely to reverse. But commodity markets do not reprice simply because structural trends exist. They reprice when capital flows align with those trends. That alignment depends on macro liquidity. It depends on interest rate direction. It depends on institutional positioning. And it depends on confidence in the global industrial cycle. Until those variables move together, silver remains a developing opportunity, not a completed breakout story. This is why experienced commodity investors rarely focus only on fundamentals. They focus on timing layers. The first layer is structural demand. Silver clearly passes that test. The second layer is supply responsiveness. Silver supply remains constrained but not immovable. The third layer is monetary policy alignment, and this layer remains unresolved. The fourth layer is capital allocation behavior, and this is the layer markets are still waiting to see shift decisively, because once institutional capital begins rotating into metals consistently, not episodically, that is when commodity repricing accelerates, not before. There is also an important distinction investors should keep in mind when evaluating narratives about shortages. Shortages do not always produce immediate price spikes. Sometimes they produce slow repricing trends. Sometimes they produce volatile consolidation phases. And sometimes they produce delayed reactions until macro conditions change. Understanding this helps investors avoid one of the most common mistakes in commodity markets: entering too early during structurally correct but temporarily incomplete cycles. Silver today may represent exactly that kind of environment. Structurally strong, technically undecided, macro-dependent, liquidity-sensitive, narratively powerful, but still waiting for confirmation from the broader financial system. And that confirmation typically arrives in one of three ways: a shift in interest rate expectations, a sustained improvement in global manufacturing activity, or a visible acceleration in institutional capital rotation toward resource sector equities. Until at least one of those signals becomes clear, volatility remains part of the process, not evidence against the thesis. Because volatility is what commodity markets look like before repricing begins, not after. So the correct framework for interpreting silver today is not bullish versus bearish. It is early versus confirmed. And historically, the investors who understand that distinction are the ones who manage risk most effectively while still capturing long-term opportunity. Silver may still become one of the defining metals of the electrification era. But markets rarely move in straight lines toward structural truths. They move in cycles. They move in waves. They move in phases of uncertainty before clarity appears. And right now, silver appears to be moving through one of those phases, which means the most important strategy is not prediction. It is preparation. Preparation for confirmation when it arrives, preparation for volatility while it develops, and preparation for opportunity when alignment finally occurs.